So today I'm recording this video, and also we're currently live to answer, some of the questions you guys previously submitted to me and my team. And also today we'll also be going through two portfolios from our existing visioneers. So let me quickly share my screen. Yeah, happy Chinese New Year to you too. Hello. Okay, great. So let me just quickly, maybe first, like always, I will go through the questions and the portfolio with you guys, and then you guys can decide if you want to stay with me until later, or you want to jump off earlier. But anyways, like you guys may know that within 48 hours, you can find the recording within our Vision membership areas for the monthly Q&A. Okay. Okay, before we start, again, it's just part of our procedure. I need to remind you guys that today is an educational and informational session. It doesn't contain any investment recommendations or any specific financial advice. And we should know investing always involves risk, and past performance is not an indicator for future performance. And we remain responsible for our own investment decisions. Okay. And actually, this week we have quite a number. I would say questions like standalone questions. I pull up actually here, and also some specific questions regarding any. I would say our visioneer specific financial situation and their specific financial goals. I will also share with you later. So I will quickly go through these questions with you. So first, is about the question. This question is about, okay, I have some cash basically now, right? Should I use this cash to invest or pay back my mortgage faster? And the second question is specifically, I would say, is in Switzerland, especially for a lot of expats in Switzerland, you have actually the choice of voluntary buy-in, like pay more into your second pillar. So here we'll discuss, basically I will share a bit about my personal opinion when it makes sense and when it's not making sense. Okay, and then the third question is also a little bit, between investing in a property and invest in the overall financial market. So it's about, okay, that person has 150K income, 500K in savings, and possibly I would say a potential property down payment is 400K. Now it's the current situation. Do you suggest him or her, invest the money in the stock market, for example, or the overall financial market, or keep renting? And I will also quickly go through the two portfolios with you guys first to see, if you feel related. So like I said, you can, stay with me a bit later as well. So the first portfolio is 38-year-old man, married with two young kids, age 4 and 7. In terms of the overall debt and saving, he has the mortgage, no other debt, and currently save 45 in cash. And he's currently live in Munich, Germany, and he earns a stable salary. And then he has his investment strategy here, and then we'll go through to review to provide feedback. And the second portfolio is a chef. So he is a professional chef based in Zurich. Actually, before this, I briefly talked to him. He's 27 years old, single from Greek, and he has a permit B in Switzerland, and his annual income is 74K, and he currently saved 25,000, and he wants to start investing early. Actually, me personally, I'm really proud of him. As for such a young age, I already have, I would say, savings and already have this kind of mindset to start investing. So we'll go through later his strategy and provide feedback. So before we go to these, go deep into these two portfolio, let me just go back to the question for this month. And also feel free if you're live now, feel free to type in any follow-up questions, for example, or if you have comments on any question or any portfolio. So we don't provide financial advice, but we will study their financial situation and goals, and then we can do this feedback session together. We learn also from each other. So for the first question, should I pay down my mortgage faster instead of investing? I would say it depends on a few factors, and one of the key factor is your mortgage rate. So as you guys may already finish our module 1, right, of our Vision Investment Academy course, the module 1, we talk about, there are 8 essential questions or ways to ask yourself before you define your investment goals. And then during that process, we share actually a number. It's actually 6%. I hope you guys still remember this. So what I wanted to say is that, yeah, investment definitely has risk. And then over the long term, using a really realistic number, I would say use 5 or 6 or 7 to predict or to kind of assume, how big your portfolio can grow in the future. So why I share this number with you now, when I highlight this, is because, it depends in different places. Mortgage, usually, for example, in Switzerland, we have a really relatively lower inflation and lower interest rate environment, right? So mortgage, usually I would say 1 to 2%. Or even less, if you're lucky. I think in previous years, like 0.7% or even lower, there is possibility. So here, what I want you to say is that if your mortgage, I know in some other countries, like for example, I think previously in China, in India, or in the United States, also the mortgage rate can be super expensive. Like the interest could be super high. Like if it's really higher than really like 5, 6, 7%, which is rare, but there is a possibility. So in this case, when your mortgage rate is super high, I would definitely if I were you, probably I will prioritize, pay back the mortgage a little bit faster, because, in the world of investment, you cannot, yes, over the past 10 years, if you invest in some, for example, global equity, US equity, you can earn on average, let's say 7, 8, 9% in return per year, right? But this kind of thing, in a really realistic sense, I would say, you cannot expect like 10% or 9%. And if mortgage rate, you already pay so much higher, like more like 5, 6%, I would say it's really hard to gain this kind of money in the overall financial market with a balanced portfolio. So in short, I wanted to say that if the mortgage rate, for example, like in Switzerland, only 1 or 2%, I wouldn't choose to pay down my mortgage faster. However, if the mortgage rate is so high, like 5, 6, 7%, I will try to pay back a bit faster, because I will not kind of expect a similar return that I can earn on the money, in the balanced portfolio, for example. So I hope, I can answer your question and some other factors. Yeah, Valentina, that makes sense. Thank you. So some other factors you should also consider, for example, does pay back your mortgage, give you peace of mind, right? Like this kind of thing, it's not financially, but it's kind of mentally, you should consider this kind of thing as well. And also how much you earn per month, right? You also don't want to put, 80% or 70% of your salary every month into mortgage pay in. So I would say overall, it depends on a few more factors as well. And but I would say one of the key or the key factor is the rate. So it depends. I hope I answer your question. And the second question we have is make a voluntary buy-in into my second pillar. So actually, I got asked this question quite often. I get more often. So let me quickly explain the second pillar payback. I would say buy-in. So it means like like in Switzerland we have pillar 1, 2, 3, right? And second pillar is, people just call it pension usually. And if you are an expat and you arrive in Switzerland, you actually have the option to buy in or pay more into your second pillar. And the advantage of it is to save tax. So for example, every year you earn 100K and you decide to pay back, and then you need to pay tax on top of this 100K, right? Deduct some costs and here and there, but usually let's say you pay tax like on top of the 100K, but if you pay into your second pillar, let's say 10K in is your pension, and then you only need to pay tax on top of that 90K. So does it make sense? So a lot of people thought, okay, now anyways, pillar 2 is my pension account, although I cannot get the money out today, but it's my money, right? And I want to pay in, another 10K or even more or less, but I want to save tax. And so from this perspective, I totally understand, it makes sense. However, I need to remind you that if you pay into your second pillar and you are not the anchor, you are not the money manager, you just leave the money there in the second pillar and someone else manage on top, for you. And in this case, and normally second pillar, they don't invest in some risk assets like stocks, for example. And the majority of your second pillar is investing in really low risk bonds. And then what I wanted to say is that in this case, you don't expect too much growth, out of this second pillar. So normally what I see the data is like every year is only less than 1%, or sometimes like 1 or 2%, definitely really, really low. You can, most of times you can just ignore this kind of return, I would say. So, like this money, normally you can only get it out when after you are 65, right? So imagine currently if you're 30 or 40s, there's still like 20, 30 years ahead. If you manage this money on your own, you can expect, for example, 5, 6, 7% per year, right? And then keep compounding. But if you just leave the money in the second pillar or buy it more, then every year, if you just earn 1%, 0.5% over the long term, 25 years, 35 years, you just like basically it's opportunity cost. You don't, it's kind of like the opportunity you're just missed here. Although you save tax, the first year tax, you save it. You see what I mean? But in addition, so what I want you to say is that it makes sense for some people to buy in second pillar. So in what cases, I would say, for example, okay, over the next 3 to 5 years, I want to buy a property in Switzerland, for example, or have my own business. And then you can get the money out because of some special situation, like I want to buy a property to live in, for example, like I just mentioned. So in this case, you don't expect the money to be in second pillar over the long term, like 20, 30 years. And then the growth you can just ignore, right? And then it may make sense to pay in, to buy in more into your second pillar. The reason why is that, okay, anyways, after 3 to 5 years, you will get money out. And then you still save tax on the first year. So I would say in some cases like this, it may make sense. But for normal cases, you don't have any plan to leave Switzerland, you don't have any plan to buy property, you don't have any plan the short-term plan, like 3 to 5 years, for example, or mid-term plan to build up your own business. So if you don't have this kind of plan, if I were you, I wouldn't choose to do a voluntary buy-in. Yeah, I see there's a question about is possible for Canadians to buy property and get a good mortgage rate in Switzerland. I would say overall speaking, to be really honest with you guys, I know, the question for this month, 2 questions is about property, but I have to say I'm not a property expert or specialist, but I can provide definitely, some direction for you guys, since I do, me personally, have some experience in buying property, for example, in Switzerland. So no matter where you are from or in like to my, correct me if I'm wrong. I mean, based on my understanding, is that no matter where you're from, you can from, Asia, the American, or you are Canadian. So you need, if you buy a property to live in, I believe you would need a permit, for example. It doesn't matter if you're Canadian or Chinese, or, like for me, I have a B permit, and with the B permit, you can already, like buy something, but you cannot buy and rent it out until you have a C permit. So shortly, I want to answer this question is that it doesn't really matter your citizenship, but you need, normally they will check like your permit, for example. And I would say that in Switzerland, if you are kind of mm, like B permit, like for if you just like what they call it is like board, if you just like cross the border or something, and you have a permit L, or I couldn't really remember this kind of thing, but basically, like in short, I just wanted to answer you that if you have a proper permit, like permit B or C, definitely you can do it. And then we also have dear friend of us, you mentioned as an Italian holding permit C, I could buy property without a problem. Yeah, and my wife has B permit, and she's allowed to buy under a certain amount of square meters. And thank you so much, Juan, for sharing your own experience. Okay, and thank you. So the last question is about, okay, should I have some money now, right? 500K. Should I buy a property, or should I keep renting and invest? So this is actually a huge question. Actually, I made a YouTube video. It's about 10 minutes something. It's about, oh, should I rent or invest in Swiss? Should I rent or buy in Switzerland, for example? So let's just talk about this case. Let's just assume it's in Switzerland. The question is in Swiss francs as well. So what I wanted to say here is that me myself, I have a hard rule, or whenever my friends or family ask me this question, I will give them a hard rule, which is if the down payment really accounts for the majority of your net worth, the majority of your savings, I will probably pause. And the key reason is, like, for example, if I assume it's the first property for you, right? And then you want to live there, for example. So especially in big cities like in Switzerland, in Geneva or in Zurich, you could see the property market has continued, I would say, quite strong, right? Like over the past few years, I would say, you wouldn't see a price drop, for example, over the past 3, 5, even 10 years longer. You see kind of more like in big cities, a price increase, year by year. But even so, what I was kind of like worried at, if I don't know that this person, if you're single or if you're married, right? Like if you buy a property together or separately, it also matters. But a hard rule that I would kind of apply, or I would advise my friends or family to apply, is like, now I have 500K. If the down payment, like this friend, is already 400K, probably I wouldn't buy. The reason why is that you have so much concentration risk. So here we're not only talk about financially, but also, like previously I mentioned, mentally as well. Yes, I believe, you have a really stable income with a stable job, you earn 150K per year. I mean, what if, this kind of thing, touch wood, you will not lose your job, but this kind of thing happens, right? There is a possibility. What I want you to say is that you focus 80% of your wealth into a property that's, your life is tied with it, right? You need to pay back. Let's assume the property is 2 million, and then 20% is 400K. You need to pay back, in Switzerland, you don't need to pay back 100%, but you still need to pay back, like roughly some amortization, and the interest will give you, I would say, so much stress if the kind of like the down payment already accounts for so much of your net worth, and then what if something happened to you, right? And then if you need to sell, for example, sell stocks. And the second thing is about liquidity. So the first thing about concentration risk that I just mentioned. The second thing is about liquidity. So for example, if you invest in the stock, bond, overall, financial market, just in case something happened, you want to have your own business, you need the money for something, and then immediately, whenever you want, you can get the money out, right, in cash, and you can use. But the property selling in Switzerland is definitely not that. I mean, I'm not saying it's impossible, but definitely takes a bit longer. It's not like 1 day or 2 days, right? If you want to sell something fast, you need to pay, you probably need to give a discount for, and then usually if you sell over the really short period, like 3 5 years, and then the tax on the price appreciation, it is so high because the government doesn't encourage you to just like to sell your apartment for profit. So I would say overall speaking, in terms of liquidity, in terms of concentration, if I would say 500K, I wouldn't put 400K to buy a property given these two reasons. And there are also some other factors I would say overall you need to consider, like we're canceling Eigenmietweg, right? The virtual rent. I heard, I bet some of you guys may have heard of it. So, but till now, we still need to pay it, right? Until the policy is really canceled. So there are still, a lot of nuances here and there. And I will, if I were you, if you're really interested in this topic, rent and invest or buying property in Switzerland, I do have a couple of YouTube videos. So just go on this channel, Charlene Song, and you type property, or if you find some most viewed videos, I would say some of them are about property as well. So I hope I answer your question. And now we spend this time, the next, I would say 40 minutes, we will go through two portfolios, like real case studies from our existing, I would say students or clients, and we can study, together. And if you guys have any feedback regarding this two portfolio, feel free to write in the comments area as well. And I know some of our clients and students were asking me, "Oh, Charlene, previously I was thinking, we can do this call in Zoom or in Microsoft Teams." And then recently I received some messages or emails saying that some of you guys may not want to show your face or even use your own name, because like finance thing, I totally also understand it. People really care about privacy or so. So if that's the case, unless you guys want to in the future to move on Zoom or Microsoft Teams, so you can also just raise your hand and ask questions. But if you prefer to not show the face, because finance this kind of thing, you don't want other people to know your specific problem questions, so we can remain in this chat. So for example, you can always use a fake name if you don't want to show your real name. I just wanted to bring it up, but you can just let me know if otherwise. So let's see portfolio number one. So he's a 30-year-old guy, married with 2 young kids, and he has a property, right? So he still needs to pay 520K remaining, no other debt, currently saved 45K in cash. And he lives in Germany and has a regular stable salary, 7,800 euro. And the tax in Germany is quite high, right? So after taxes and social contribution, he has about 4.8 thousand. And his partner works part-time, earns about 1,400 per month. Okay, Okay, and his investment goals based on his financial situation, he wants to build an emergency fund first and start investing. And currently, he's not investing at all. And his long-term goal is to accumulate 500K in investable assets by 55. So he's currently 38, right? So he has 17 years time horizon to have the option to reduce work hours or retire semi-early. And I also want to say for kids' university education, roughly 30K per child. I think, currently the child is still young, but it will be still a long-term goal, 10 to 12 years. And let's see what he plans to invest in. And obviously, he consult also, I think also previously, he consulted a financial advisor with his current bank in Deutschland. So that's why you can see quite obvious, like he has some active managed fund here. So let's review his investment strategy together. So he plans to invest 800 per month once he starts, and he plans to use he used Deutsche Bank, Active Invest, recommended by his bank advisor, and the current or the proposed strategy by the banker advisor for the bank advisor is 40% in the Deutsche Bank DB Deutsche Bank conservative SAA. SAA stands for strategic asset allocation, so it's like conservative portfolio, and 35 in the active managed fund and dividend fund, and also DWS is the asset manager, is also part of the DB Deutsche Bank group, and 25% in two actually single stocks in the telecommunication sector. So let me know, in the chat, what do you think about his strategy based on his investment goals and based on his investment, I would say, his financial situations. So if you ask me, I would say, oh yeah, before that, I wanted to add that he actually has some specific questions. So is the bank advisor's recommendation good or not? We will review that together. And then the second question is how realistic is my 500K goal given my savings rate? Because he wants okay, in 17 or something years, right? He wants to have 500K, and then every month he wants to invest 800 something, right? That's what he mentioned. Yeah. And the third one, I think we already covered in our previous Q&A just now, right? Should I pay down a mortgage faster instead of investing? So let's look at the first two questions first. And, with that, we will just review his portfolio directly. So I would say from just based on his own financial situation and goals, the good thing, the strength of his financial situation and goals and the overall investment strategy is that he has a really long time horizon, right? He said, okay, long-term goal I really see after 10 years, 20 years, or basically here we're talking about 17 years, is long enough, I would say, definitely to build a meaningful wealth strategy through compounding. So if they say, okay, next month or next year, I want something, my goal is to achieve how much, it's unrealistic. But if your goal is really long-term, over 10 years, I would say definitely long enough to build something meaningful. And the second thing is about, I would say he and his wife, he has double, I would say, income sources, also provides a quite reasonable base to invest consistently, right? Because you want the, you don't want to, this month you invest quite a large amount and the next month you stop, and then after that, the fifth month, you invest, again. So I would say consistency really matters, and then stable income also provides him a reasonable base to do that. And I would say he also mentioned that his main debt is mortgage, right? And is his only debt. Although he didn't reveal how much, the interest that he pay on top of those mortgage, but I would assume, overall in Deutschland, in Germany, it's manageable. I believe it's kind of like a low single digit, right? Like 2, 3, or even lower, I hope. He didn't mention that. So if that's the case, he doesn't have, consumer credit card debt. Usually credit card debt is super high, right? Compared with mortgage or car loans. I would say overall speaking, it's really manageable. And he already motivated to start investing, I would say already ahead of many peers. And now, okay, that's a full page in terms of areas to be mindful. But I would say again that previously when we review, investment strategy, we say strength and weakness. And now we don't, we stop saying weakness, and instead we say areas to be mindful of. I would say there's nothing right to be wrong, but you really need to be, I would say, kind of reminded of certain risks that you may not be, aware of. So first of all, I wanted to highlight that his approach is, to bank with his familiar bank, Deutsche Bank, right? And bank recommended products are usually very high fee, I would say. He mentioned the balanced portfolio, right? Or conservative SAA portfolio, the first one. And the second one is also active managed, a dividend fund. I was overall speaking, very likely, they charge you the total expense ratio is about 1 to 2%. It's just general. Like for example, if you go to UBS today in with your local banker, then obviously they will ask you to buy a certain fund from UBS for sure. If you don't trust me, go. Like previously, I worked for JP Morgan, on the asset management side. If we go talk to clients, obviously we want to sell our own funds, and usually they are extremely expensive in terms of TER, total expense ratios. Okay. So what I want you to say here is that unless in the second module, when you learn active managed fund and when you learn ETF index fund, I hope you guys finish this module, second module, you will understand that in which cases I would kind of go for those active managed funds or active managed solutions, unless you really prove that you outperform the market over the long term, or is you can offer me certain expertise that I cannot have with low cost fund, then I possibly would consider the active managed fund. But if I were you, if they don't kind of provide me additional, and they instead they still charge like 1 or 2% fees annually, then like we just mentioned, right? An equity fund on average, you probably can expect 6, 7% in return. And they already take 1 or 2% of that 5, 6, 7%, then is the fee is, I would say, quite a bit. So I would definitely kind of, if I were you, I would definitely review if I still want to, bank with, to have my investment account with my local bank, like in this case, Deutsche Bank, right? I probably wouldn't do so. And the second thing I will highly, highly advise, I would say I will highly, highly review is the single stock exposure to Deutsche telecommunication sector. So I would say, you only have to, he didn't mention this company's name, but if you have 20%, 25% of your own portfolio just in 1 or 2 single stocks, it's definitely provides you, in my opinion, some really unnecessary concentration risk. So why, right? And I guess maybe that person, you work in the telecommunication sector, and usually people work in a certain sector, they know this sector, and then they want to, invest in their own industry. I kind of understand this kind of mindset, but if I were him, probably I wouldn't do so. And the third point I wanted to highlight is his contributions and his goals. And let me quickly share my screen. I wanted to, I think we did for a couple of times regarding how to review, your investment goals. For example, long-term goals is specifically is realistic or not. What we use is the compound calculator. Let me quickly share my screen so I hope you can see it. So if you Google compound calculator, usually the first one is actually from the US Securities and Exchange Commission. So let's say in his case, right, and he, or in whatever cases you can use, for example, how much he saved, let me see how much he saved now. Oh, save 45K in cash, right? And then every month he can invest 800. So, can you still see my screen? Okay, now it's good. So let's say he has some savings on the side. He doesn't want to invest, right? You need to have some savings, or let's call it emergency fund. Let's say 20K on the side. He doesn't want to invest, and instead he invests 25,000. And then he mentioned every month he wants to contribute 800 and 70 years, right? 17 years time horizon, and then let's just use 6%. To be, I would say, to be realistic. And every month I use, monthly compound frequency. And let's see, in 70 years, how much he can potentially, kind of have. So in 70 years, the green one means how much you contribute. So every month, 800, and at the very beginning, 25K. And that means you contribute 188K, and then you can expect, I would say, from realistically, you can expect roughly 351K in 17 years. So which his goal is 500K, right? So I would say either you can have a bit longer time horizon, like in 20 years, let's say how much, or you increase your monthly contribution. Yeah, so in 20 years, actually, it's already 452. So I was slightly slightly for short, but definitely, something that so much better than savings, right? So that's the way that we kind of like evaluate if it is realistic or not. And the next point I wanted to mention is like, you didn't mention the emergency fund. He has 45K, right? And if I were him, definitely I will have an emergency fund in place before I invest. Like I just show you the compound interest calculator. So usually globally, we advise people to have 3 to 6 months of expenses on the side as emergency fund, just in case you break your arm, and just in case your family there's something happen, right? In life we lose our job, I mean, touch wood, but this kind of thing could happen, so you have some savings on the side instead of selling your investment. So I would say I will put some cash on the side and then invest the rest of it. And also, he didn't mention some tax advantages accounts. So in Germany, I'm not an expert in Germany per se, but each country, I believe most of the countries, especially in Europe, we have this kind of tax tax advantaged account. For example, in Switzerland, we have Pillar 3A, right? Like in Germany, they also have some kind of like plans. For example, one called Sparerpauschbetrag. Okay, pardon my Deutsch. I mean, I really try to pronounce it. So basically, he didn't mention that. What I wanted to say here is that also, do some, certain research, and if you invest in the future for your own future, but also can save some taxes on the side, then why not? And then last but not least is about the conflict of interest. So I wanted to say that most banks, like I mentioned at the very beginning, they will recommend their own in-house products. They're not only expensive, but also quite, I would say, biased, because there are so many other products out there. But let's just see quickly his strategy. So I would say, overall speaking, the first two, it looks a little bit too kind of conservative, because he wants, his main goal, right, is long term, 17 years, how much he wants to build. So if I were him, I would probably go for first a global equity as an ETF or index funds. It's more growth oriented instead of conservative or top dividend fund. Instead, I want more growth oriented, because my time horizon is 17 or 20 years. And then secondly, let's go back. I would say I wouldn't choose just like 25% into two single stocks, even though I know telecom, industry, although I work in this industry, and I still, if I like, I would probably to maintain this kind of exposure to, let's say, 5 to 10% maximum. I don't want to, 25% of my total wealth or something like that to be just into single stocks in one sector. Okay, let me know if you guys have any further comments. You think, okay, I found something that he should be mindful of. Let me know. Let us know in the chat as well. It's the good ad. He doesn't have alternatives. Exactly, he doesn't. I mean, it's not a must, but if you want to further diversify your portfolio, I would say definitely, on the long term, you could also consider some, like I say, gold and silver, or these kind of cryptocurrency, like for example, super volatile, right? But I wouldn't suggest you to put Tisha, you mentioned 10%. Yeah, you can put possibly 5 to 10% into alternatives overall. And in the second module, we also um, learn learn this overall alternative assets as well. Yeah, we have a question. Hello, Theo. Would it be easier and more simple if someone invests in retirement fund? What do you mean by saying retirement fund? You're more talking about, I guess, like for example, Pillar 3A, like this kind of retirement pension, right? I assume. So he's currently based in Deutschland. He based in Germany. They don't have 3A per se, but definitely, I totally agree with you that if you're in Switzerland, I will definitely, me myself, I also have my retirement fund, like with a Pillar 3A account, basically with V.I.S.I.O.N. And if you really have a long-term horizon, I would definitely advise you to do so. Not only invest for the long future, but also saving tax. And one little thing you might be considering is that those retirement funds, unless there are some occasions you can get money out, right? Buying a property, having your own business, leaving Switzerland, for example. But unless these, otherwise you need to put the money until you're 65, right? And for a lot of people, they may want to do something, before 65, and this may not make sense. But if you really have those kind of long-term horizon, definitely, especially you live here, I would say it definitely feel you are right. It will be definitely simple and makes sense to invest in this such retirement fund. And let's go to portfolio number 2. So again, all these kind of portfolio is on an anonymous basis, but if you happen to be here, and yeah, feel free to ask any follow-up questions so we can discuss together. Okay, so let's go to portfolio number 2. So it's a 25-year-old man from Greek. He currently lives in Zurich, Switzerland, with a permit B. And the current situation is that he plans to stay here for the next few years, but probably not forever. And he's currently 100% employed as a professional chef. Great. And his annual income is 74,000, and including 13th salary, and also he shared the net salary here as well. And he currently saved 25K already, like in his savings account. No mortgage, no other loan, right? And I'm considering, he said, starting pillar 3A and buying a property in Germany, okay, as an investment. Yeah, I have got comment here. In Switzerland, you can buy into your second pillar as retirement investment. Yeah, actually, we just discussed about this at the very beginning one. Does it make sense to does it make sense to buy in more, for example, and top it up, for example, for second pillar? And you do have the choice, and we just discussed. I don't know if you stick with us at the very beginning. So we also discussed a few scenarios when it makes sense to buy in, when it is not. I hope we can also listen to this recording later. So let's go into his investment goals. So short term, he mentioned he wants to buy investment property with a mortgage. He didn't share, specifically. I don't know, if you already did some research. When do you want to buy it, and how much, potentially you want to buy, for example, in Germany. And long term, he wants to retire early and comfortably. So I didn't. I just put actually 500K here. so. So we can review like how much and he can potentially kind of achieve in the long term. And he mentioned that he want to focus more, on the wealth growth with long-term financial independence. So I assume here is that, okay, just in case there's some conflict between different goals, but basically we cannot have everything, right? We cannot have, okay, I want a house, I want do this, that, set up my own business, need another 200K, I want, retire early in the 10 years. So basically here, what I understand, based on my understanding, is that, he wants to focus on wealth growth with long-term financial independence. This is the focus. And his current strategy, so IBKR, VIAC for third pillar, right? And he has I would say, really great in terms of the simplicity. He has the three I would say vehicles, let's say, and 70% in VOO, 20% in VT, and 10% in VIAC. And he plans to invest between 500 to 1,000 per month consistently. Recently started, only a few hundred invested so far. Okay, good to start. You need to start and learn from the process, right? Learn from doing. Great. And he has some additional questions. So is this investment plan and monthly contribution realistic, right? And then we can also use the calculator, for his situation. And secondly, any adjustments to the allocation or strategy. I think he also had a previous question regarding, how can we make this assessment better? So I would say, going forward, if you guys submit any kind of investor situation and goals, there's no, guidelines, I would say, specific guideline, but I would encourage you to provide as much details as you can. But I also understand for a lot of our students, you really appreciate privacy, right? You don't want to share too much, how much you earn, and like the property information, how much you have in each bank's account. So I would say, from our perspective, the more detail you provide, the more definitely a better assessment that we can do, but also depends on your comfort level. Okay. Let's see the strength of this portfolio. So I would say it's that really debt free at 27, and it's really starting at a young age. It's give you so much power, so good. And I would say time and compounding are fully on your side. I would say congratulations. And he also already saved 25K, right? I believe, I don't know how long you've been working, like for example in Switzerland or elsewhere. I would say overall it can also shows he has real financial discipline, right? And I see a lot of expats who move to Switzerland and suddenly you receive a huge, not a huge amount, but definitely higher salary than elsewhere. And then people start to, okay, lose themselves, do a lot of travel, do a lot of trips, bars, restaurants, and then by the end of the month, they don't save anything. So I would definitely not encourage that. And so I would say in this regard, in terms of budget, I believe he definitely, does a better job. And then next point, I wanted to say the platform he chose is also, I would say, quite, makes sense. IBKR, if you really start small, like if you want to invest few hundred here and there, you definitely want to choose platform that costs less, right? You don't want to choose a really expensive bank or even Swiss code, for example. I think I wouldn't choose, a platform that costs you really. IBKR, I would say overall, it really safe. It's really cheap. It's also quite a decent international platform, and V.I.S.I.O.N also. And the next point, the the next point, I would say the pillar 3A and also Theo, I think in the comments area, you also mentioned in retirement fund. So I would say, for this portfolio, this student, this engineer, he also mentioned the pillar 3A, definitely, especially for some high earners, you invest in your own future, but also enjoy this kind of tax savings, definitely. And also VOO and VT, and two very popular, I would say, ETFs, low-cost instruments with broad market exposure. Now let's spend a little bit more time on the areas he should be mindful of. But before we go in, let me know in the chat, what do you think is, let's try together to find some little problems or some areas that if you were him, you want, or you are his friend, what kind of advice that you want to give him? Or you think, maybe he should do something else instead. So let me know in the chat if you already have some feedback. Got my water. Okay. Probably very high US exposure. I like it. Overlap between S&P and total world ETF player, Rebecca. Thanks for your comment. Yeah. So let's go through the areas to be mindful of. Exactly. The first point that I put here is really about the overlap. So, VOO and VT, VOO invest in the US market, right? S&P 500. And VT invest in global equity. And within VT, I think we discussed about it a few times. And I would say 60% or even more, I think, of VT is invested in a US company. So what I wanted to say here is that usually, for the equity part, we wanted to kind of like have wanted to have an overall kind of global exposure, right? And some people say, okay, the global exposure is good, but in addition, I want more US, still want more US. So in this case, yes, you can do VO and VT together. But if it is not your intention, I wouldn't do so. So for example, VT, we already have the majority of it in the US equity, right? And then you have another US equity. So unless it is your intention, I wouldn't do so, right? And usually people will say, okay, VT is the global equity, but I don't see they have much European exposure. But I want a bit more European. And then they choose a VT plus the European ETF or index funds. If they want it, it makes sense, right? So what I want you to say here is that I'm not saying you're doing wrong, but I want you to do it intentionally. So unless you think, okay, VT doesn't have enough US exposure, I want even more, then you can do it. But probably I don't believe like you think this way, right? So this is definitely, Claire, Rebecca, you also mentioned, also Scanner, you mentioned this. I would say definitely I would, this is the first piece of kind of points that I wanted to highlight. And also, he didn't mention the emergency fund. So if I were him, I will probably, use a certain saving, let's say 3 to 6 months, or if not, if you live in Switzerland, I would say it really depends, right? This kind of emergency fund, the purpose is to give you kind of like to give you kind of peace of mind. So it doesn't really matter 3 months, 6 months, or 2 months, or 4 months. I think specifically in Switzerland, we do not really have, we have really good, systems, right? When there's something happen to your health, there's health insurance. And even if we lose our job, and there is RAF, right? RAV, who cover these kind of costs over the 2 years like normally. So in this kind of safer environment, I would say overall speaking, you don't need maybe 3 to 6 month expenses as emergency fund, but maybe 1 to 3, maybe 2 to 4 like this. So I would definitely have some emergency fund on the side, just put in savings before, and then I can invest the rest of it. And then the next point, wait. And the next point I wanted to mention is German property. So I think he didn't really mention when he wants to have this kind of purchase, the down payment. But overall speaking, when you buy a property, you need to pay upfront, right? And then you need to pay back the mortgage in most cities that in 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 Switzerland, maybe you don't need to pay back like 100%, but in most other countries, you need to do so. So what I wanted to say here is that if you want to purchase a property over the short term, I also wouldn't just take too much equity risks. So equity, I would say overall speaking, is risk assets, and it's really for the long term, like 10, 20 years, I would say long term. And then no one can really guarantee you that over the short term, let's say if you want to purchase a property over the next 3 to 5 years, and your portfolio will go up how much? Maybe it will go up, maybe it will go down, right? So what I want to say is that if I know what you want is like more long-term wealth than short-term, let's say property or something. But if you balance these two, if you think the long-term is more important to you, your current strategy or the global equity plus a little bit Europe or Asia, it makes sense. But if you think, okay, I want a property more and it's more important than my long-term wealth, and I want to invest for the short term, 3 to 5 years, then I wouldn't put 100% into equities. You know what I mean? So it really kind of like balanced between your goals. So if the short-term goal, buying property, is so important to you, I will use a more balanced approach, a balanced approach of both, equity, high dividend, equity, bond, and short-term bond, these kind of instruments. But if you don't think that is so important, you want to focus more on the long term, then 100% equity is actually, or more 80% in equity, it makes more sense. So I hope, it makes sense to you. We have some comments here. Let me just quickly show. Compared to XUS, I think IXUS, for example, let me just quickly put it into Google. It says iShare Core MSCI Total International Stocks. So, for this kind of thing, we have what I want to say, or ITOT is also TOT. It's also an iShare total US stock market. I would say, whenever you invest, there are just so many different options, right? I think if I remember correctly, I think last month we go through, like, for example, invest in one single index. There are just so many different options. We are always one option, right? Like what we just mentioned, to invest in the US equity. You can also choose, ITOT, for example, iShares. So what I want to say here is that you guys can refer to a YouTube video called "The Best ETFs in Switzerland" for Swiss investor. You can check that video. So I would say, in short, it doesn't, as long as you want to invest in US equity, and then both of them are ETF, they are from famous kind of investors. VO, for example, from Vanguard, right, and ITOT from iShares. There are some differences in terms of nuances, but you invest in US equity. So from the bigger picture, it doesn't matter that much. But if you really want to go into the nuances, I advise you, to watch the video called "The Best ETF for Swiss Investors." That video. So in that video, we explore the 5 criteria when selecting ETFs. So, for example, index qualities, for example, domicile, for example, currency, for example, expenses. So I would say that will definitely, help you a bit. Okay. And the next question is about short-term, mid-term. What will be good instruments? So for this, we do have some examples. I would say in third module, we listed different indices, right, and then also different instruments. So here, what I wanted to highlight is that I don't want you to just follow those instruments and invest. Do a bit more. They are just examples, and I don't want you to feel that they are the recommendation from me or my team. So we really want it to be renowned and also independent as well. We also don't take a cut for example, for product recommendation. And I would say highly advise you to take it just as an example and also find some other alternatives as well. And if you in the end find 2 options and you are not sure to which to go to, you can also bring some questions to our next, for example, Q&A. Okay. The next point I wanted to mention is the early retirement that he wants to achieve. So again, he has a question regarding how realistic, right? Would you again, like, how realistic, given my situation, the investment plan and monthly contribution? So what I want you to say here is that, again, we can use, let me share my screen. So we can use this calculator to calculate. So let's say he invests 10K today. Every month, how much he wants to contribute? I forgot again. Someone reminds me. Okay, let me find. Okay, 500 to 1,000 per month, right? So that is, let's just say, let's use 500 first. 20 years, 6%, then you can possibly expect 264 in 20 years. That's almost double your contribution, right? You contribute 130K. And if you say, okay, every month I can contribute more, 1,000, then that the number is, actually it's almost 500K. So here, how realistic or not, you can use this calculator to calculate. And then in terms of, if 500K enough for you in 20 years, that just another question. Depends on where you live, right? And how you want to, do your retirement life. And one thing that, just in case I forgot, I wanted to remind you guys that actually, if you search 10 retirement checklist on Google, okay, if you are really interested in early retirement, this topic, I will I will encourage you guys to read an article. That's okay. Let's share screen. Yes, here. So if you're just typing Google 10 retirement checklist, actually, I'm quite happy. The first one is actually from Swiss Quote, preparing for your retirement, a 10-step checklist for new retiree. It's actually written by me. So they invited me to be to write on their website to write a blog regarding retirement or early retirement. So this video actually, let me type in our chat also, or you can just like Google early retirement checklist. And then in this video, we give basically, I provided 10 steps or 10 checklists that you should, take before you plan your retirement strategy. Okay, I just wanted to mention this. So if you're interested in this topic, you can check it later. I just put the link here. Okay, lastly, I think there are still some comments for this portfolio, right? Okay. Lastly, I would say, we already mentioned the short-term, long-term goal balance, right? Depends on which one is more important to you. Basically, we cannot have everything, right? And then you can depends on the short-term or long-term, and based on that, it depends on how much risk or how much equity exposure you want to take. And I hope it makes sense. And lastly, I just want to remind you, our professional chef, that when you invest, when you do the V.I.S.I.O.N account, there are also different portfolios, right? You need to choose like, okay, I want to choose this and this and that. So here, I just wanted to remind you that don't just put everything into cash account because yes, you can still save those taxes, but in the long run, right, you invest really in the future. Especially for VIA, for pillar 3A, is really kind of invest for 10 years, 20 years, unless you need the money in the short term or you leave Switzerland in 3 or 5 years. So if I have a really long time horizon, I will invest the money within VIA into, let's say, equities. So my portfolio at VIA is 100% or 99% or 98% in equity. I choose the most risky portfolio. So it's kind of just a reminder based on your time horizon, choose the investment within VIA instead of just putting the cash. Okay, so I hope the portfolio review is helpful, not only for these two visionaries, but also for you as well. And let me know if you have any further questions regarding these two portfolios or any other questions. So I will be here for as long as you need me. Okay, we have another question. Hey, Charlene, what do you think is the most convenient strategy for investing 100 a month? It's a big question. So if I have 1,000, so again, depends on your investment situation and your investment goals, right? So in short, it's a big question. So I will definitely, I don't know how much you finished the course yet, finish or not, but the whole system is to teach you how to evaluate your own financial situation and how to build your short-term, midterm, long-term goal, and based on this short-term, midterm, long-term goal to invest differently. For example, if I have 100,000, I want to invest 1,000, not 100,000, not 100,000, sorry. If I want to invest 1,000 per month, I am, for example, if I am 35-year-old man, want to purchase a property in Zurich in 7 years versus I'm a 55-year-old woman who want to prepare for my retirement versus a 20-year-old young girl who wants to do early retirement in Thailand versus a family in their 40s and they want to raise their kids together. So the four portfolio, you definitely, wouldn't invest the same, right? So again, it depends on so many different scenario and options. And then here we mentioned that I'm 29-year-old, currently with 50K in saving. So I I cannot, based on this limited information, I cannot tell you, exactly what you do. But I can, for example, roughly, I would say if you really want to invest in the long term, I would definitely go for some risk assets. For example, equity or alternative investments. And if you have some short-term goals, I would go for some I would say less risky, like more conservative approach. And don't feel intimidated. Just start learning, and also start doing. We always just like learn from doing it. And okay, thank you. So thank help so much. Okay, I'm so happy to hear so as well. And you know that where you can find me. If you're, obviously we're Visioneers, then you can always email me, either me or my assistant. We'll get back to you. And if it's something really urgent, I will, we will reply to you quickly. And if not, we will save those also questions to our next call. Okay, and thank you so much. And you will find the recording within 48 hours in our membership area. And till now, our next time, I will see you soon and take care. Ciao, ciao.